Hello, I'm Ion-Marc Valahu from Clairinvest. I'm the Chief Investment Officer, and today I'd like to go into details and analysis about Chinese markets and emerging markets, as they've been hit hard over the last couple of years. What we will look at first at the indexes on the Hang Seng, which is the general index of China. And as you can see on the graph, the valuations have been taken down a lot. We're now back to about 2008 valuations in terms of prices and also on PE multiples. If we look also on the MSCI emerging markets, the market has held up a little better, but still it was impacted by the general situation following the COVID lockdowns. China has been hit hard in the sentiment side also. I mean, a lot of investors think that Chinese market is now uninvestable, that the economy is never going to recover, and also the public opinion about China from a European side or an American side is very negative. And we think that there might be an opportunity. It warrants to look at the Chinese market and the emerging market. Since COVID, of course, they made a lot of mistakes. China locked down too hard, took a long time to open up its economy. Asian markets kind of followed through on the same logic, and they were really hard hit. At the same time, they were coming off a very exponential growth period. So now we're just a reset to the fundamentals. But now I think that given the discount, and for example, the Hang Seng, which is almost down, I would say over 30% in the last couple of years, it warrants to look at, because although they had problems in the real estate business, there was a kind of a bubble, a lot of construction, a lot of development. They wanted to get the economy running. They wanted to get a lot of the population out of poverty into the middle class and the upper class. And so that needed a lot of investment. And as usual, it always ends in a bubble. But I think the bubble popped, at least in the real estate business and the equity business. The potentials are there. So if we look just coldly at the economics of it, when you compare to Europe and the United States, the debt levels are much less in the emerging markets and in China compared to the US and Europe. They have, therefore, the rates are not as high, and they've been able, after the Russian invasion of Ukraine, they've been able to recenter themselves and actually develop the BRICS, which is all the emerging markets country getting together to do business together, as opposed to doing business only with Europe and the US. For example, with China, and also we can talk about Vietnam. China is now the leader, as you can see from this graph, in automotive industry. It's now surpassed Toyota as the #1 car seller. Their main objective is to be the leader in the regular cars, or if we call it oil cars, then used cars, and now they want to move into EV, and they've already managed with two of the leaders, which is BYD and XPeng. They've been able to capture pretty much all the markets, and keep in mind that all the batteries are made in China, and so any automaker in the world that wants to go and develop an EV car and wants to produce fast and put into the market, they need mainly Chinese batteries. So there's a lot of fighting between Europe and the United States to block China from developing, but they've already made the leadership, and so therefore, right now, the only game in town. In addition, what they've done over the last couple of years is that they've been energy sufficient. And as you can see from this graph, now China has pretty much developed a lot of nuclear power plants, so that will give them zero emissions. They have a number of nuclear plants under construction that will give them an advantage for the energy transition. We hear a lot that China uses a lot of coal, a lot of gas, a lot of oil to produce energy, but yeah, that was part of the development. You have to take it step by step. But in the development, they also thought out about building a nuclear park so that they will be able at some point to switch off the coal plants and then move to zero emission economy. They're also a leader in the solar panels globally. So you can see from the graph, pretty much the only buyer on a cost basis are Chinese solar panels that have been used in Europe and in the United States. Again, the competition is really hard. They're trying to put barriers on emerging market or Asian producer and China producers. But as you can see, if you want a cheap, affordable solar panel, the only way to produce it on a cheap basis, on a cost-related basis, would be from China, mainly. All in all, it tells us that with a PE of 9 for Chinese equity, compared to about 22 to 23 PE in the United States, about 18 PE in Europe, there's an opportunity. Of course, it looks scary, the market has been going down, but at some point, switching at least some of your assets, and usually on emerging markets, it's about 5 to 10% of the portfolio. It does make sense to diversify, especially when we have equity markets in the US and then in Europe that have been only going up for about the last 7 months. There's a lot of debt, there's a lot of speculation. Valuations are very stretched, especially if you look at the 7 magnificents or the tech sector. It could go on for sure, but why not look at other countries that have a better valuation and are still growing, even though they have had a little bit of a hiccup in their economic development. So all in all, I think that those regions are benefiting from it. And keep in mind, also, we've had a major increases in interest rates in Europe and in the United States, and it hasn't hurt the development of the emerging markets and China. They've been able to finance themselves, to actually do cross-business, not use as much the international debt markets, and they were buffered from an increase in the dollar and the interest rates. So it looks to me that they've been able to weather the storm. Now they've made some political mistakes for sure, but for the long run, I think it's a good entry point. If you look, for example, at India, was the #1 beneficiary from the war in Ukraine. Russia had to switch selling Russian oil, and now they're selling it to India. And so India now gets unlimited amounts of energy. Now will be able to develop their country, as opposed to before where they had to compete on the international markets for oil. Now they have unlimited access, and as you can see, for the last about year and a half, India stock market has been on fire, and the economy also has been growing. And with the young population that they have, a lot of more people will get into the middle class, and that will feed on itself. It's not all bad that the sanctions have been put on Europe. It's that they actually benefited a lot of countries around the world that don't want to take part in the conflict, and they want to develop their economies at the expense of others, because keep in mind that the world is always in competition. They are friends, but they ultimately they work for their country, their population, and they want to develop. So all in all, we have a few examples that it be from India to China, to Vietnam, to the emerging market in general. China looks to be an interesting investment for the next couple of years as they recover from the COVID and they expand again on the world stage. Thank you very much, and happy trading.